What's going on, guys? Welcome back to the Finance Basement. Thanks for tuning in. Remember, I always encourage any of you guys listening out there to ask me questions directly. I'm going to lay out a few methods to contact me down in the description, whether you're listening to this as a podcast or watching it on my YouTube channel. I recommend just, always ask me anything you need, ask me anything you want, and I will try to get to it, whether in my content or whether on a future podcast episode. And without further ado, we're gonna start this episode off like all the others with today's interest rate. So today is Wednesday, April 8th, and today's interest rate is 3.77%. And I believe the last time that I recorded an episode, it was in 3.85 or somewhere in the high 3/8, somewhere in there. So we're noticing a little bit more of a downtrend now. That's great news for first-time home buyers, great news for homeowners trying to refinance their homes, because interest rates are going back into an attractive area like they were earlier on in the year or at the end of last year. And while we're on the topic of interest rates, today I wanted to cover the quickest ways to boost your credit score. Now, as many of you may know, credit score plays a big role in what interest rate you're going to be offered. So you walk into a lender's office, if two borrowers walk into a lender's office and one borrower has a minimum credit score for a conventional loan, 620, and the other borrower has a 700 middle credit score, their interest rates are going to be drastically different just because of that credit score. So it's very important to take care of your credit score, and if you haven't already, you should review it. You should pull your credit. So with that being said, let's talk a little bit about how credit affects your interest rate. So it usually works in tiers of 20. So we'll start at the base being a 620 middle score, right? For a conventional, just for an example. So if you went from 620 and you improved your credit score to 630, that wouldn't really make a difference in your interest rate offered. But now, let's say you took that 620 middle score and you boosted it all the way up to 640, 641. There, you would actually see a decrease in the interest rate offered to you. Why is that? These credit scores, or the credit scores that are considered in tiers of 20. So anywhere between 620 and 640 is basically the same thing as having a 620. But anything above 640 would be considered in the next tier. So you would get offered a better interest rate. It's very important to keep in mind when you're working on your credit. Now, currently, especially with the whole coronavirus panic, it's very important to keep your credit scores up high to get the best offers, not only on mortgage rates, but also, if anything that you're taking out, maybe a credit card, a credit line, whatever you're doing now to stay afloat, it's also really important to work on your credit so that you can get the best rates. Moving on, we are going to talk about the free credit report source that I recommend all my listeners, anyone who listens to me, use. It's called annualcreditreport.com. This is a free resource. Once a year, you can pull your credit on here. You get all your credit history, all your current credit lines and your credit history, and it doesn't affect your credit score because it's an official website from Experian, Equifax, and TransUnion. So it's a free resource given to consumers, for you guys. And I recommend always, if you haven't already, pull it just so you can review what's on your credit. If there's any disputes, anything that you don't see, or anything that you see that doesn't add up, then you'll be thankful that you actually use the resource and you're seeing it now instead of later on. That way you can dispute it and fix it instead of waiting for it to affect you later on down the line when you're actually applying for something. So, without getting too much into that, we're gonna move on into utilization, right? So credit utilization is basically, the easiest way to explain it is, if you have a credit card and you have a $1,000 balance, a $1,000 limit, then utilization is the percentage of that credit limit that you're using. So usually the magic number is around 29-30%. So if you had that credit limit with $1,000, you would get the best credit score if that credit card had a balance of $290 or $300, around there. It's not perfect, but around there, that's where your credit scores would be the best. Now, if you went too high, if you went above, maybe going near to maxing out that credit card, then your credit score would start dropping a little bit. And also, if you didn't use a credit card at all and you had a zero balance, then eventually your credit score would also lower. So credit utilization is something that affects your credit score positively, but it's kind of like a balance thing. So you need to balance out your credit limits. And moving on into the next thing is going to be removing disputes from your credit report. Now, this is something a little bit more, I would say, professional. You can remove disputes yourself, but I would recommend you talk to someone at least that has experience doing so. So you're probably gonna need professional assistance for this. You're probably gonna need to hire someone who has experience removing disputes, but it's basically gonna come down to a negotiation. You're gonna negotiate something with the creditor or with the owner of that credit line currently, and it could look something like maybe a settlement, but it's not a settlement. It would be more of a negotiation to remove the dispute that's on your credit report. Obviously, what the creditor is looking for is for you to pay the dispute outright, but you don't want to do that. So you negotiate dispute. That's why professional help is probably going to be needed, and they remove the disputes for you. Now, removing these disputes will affect your credit score dramatically. They are a big part of what's holding down most people's credit scores at the moment, today in 2020. Now, this one's a little bit more common sense, and it is paying always on time. So what does that mean? It doesn't necessarily mean paying before the due date, the original due date of your bill, but it means just never letting your bill get 30 days late. See, so you can pay your bill, your loan or your credit card bill, maybe a few days later past the due date, and you're gonna get a late charge. But that late charge or those a few days late don't reflect on your credit report until you get to the 30-day mark. So if needed be, you could wait out a little bit. Let's say you're waiting for another check, you're low on some cash, you don't have enough money to pay the credit card bills currently, and you wait just 10 or 15 days to get the money to pay back the credit card bill. That is not going to reflect on your credit report because you didn't get to the 30-day mark, and that's okay. Just try to pay it more closely on time. And if you do have any late payments on your credit report currently, then it's not a big deal. The longer or the farther away you get from the time that you've made that late payment, that 30-day, that 60-day, 90-day late payment, whatever it is, the better your credit score is going to be. As long as you're paying that and all your other bills on time, your credit score will slowly improve regardless. And that's it for that one. On the next one, on this next tip, I want to share with you guys avoiding hard credit pulls. Now, this one is not absolute because sometimes to improve your credit score, you might want to apply for something, but this one is kind of more common sense too, just like the last one. So avoiding hard credit pulls. So I've seen this happen before, even with cell phone bills, where the cell phone carrier pulls the client or the consumer's credit report, and that is known as a hard pull. So every time you apply for a credit card, every time you apply for a car loan, furniture even, and sometimes even cell phone bills, they will pull your credit. You need to ask before that happens, hey, are you going to hard pull my credit to look at my score? If that is the case, they are going to do so, and that in itself, by itself, affects your credit negatively. So avoid doing those as often as you possibly can. Now, on that same subject, I want to move into authorized user accounts. So an authorized user account is basically somebody putting you on their credit line. So let's say you have a family member or a friend, a close friend that has great credit, they always pay their bills on time, and you need a favor. You ask them to include you on their credit card or on their credit line, whatever it is, as an authorized user. Not to use the credit line, but just to help you improve your credit score. So again, in order to do this, you want to get help from someone who already has good credit, that you know has good credit, pays their bills on time, and jump on, if it's a credit card that has a lower balance, under 40, under 30%, not too low, not too high. Again, like we discussed in the beginning, the credit utilization is very important. One of the last things I want to talk about, again, staying on the same subject of the hard pulls, is actually applying for a new credit card. Now, when I say applying for a new credit card, that doesn't mean everyone. That means just the people that don't have enough credit. So let's say you had maybe one, maybe two credit cards even, but there's nothing else. That might not be enough credit for the bureaus to give you a good enough or a reliable score. So you might want to apply for another credit line, whether it be maybe even you want to get a new car or you want to get furniture and you need it. Well, then you apply for that line of credit and you make sure that you pay all your bills on time and your credit utilization is lower in that 30% range, and that will dramatically improve your credit score as well. Now, the last thing that I want to talk about is more of a mortgage tool used for borrowers that want to either qualify really fast or they want to get a better interest rate immediately. And that is called the credit rescore. Now, this is something that will drastically improve or switch a borrower's credit score from not qualifying to very qualified. I've seen the credit rescore take a person's credit score up 100 points before. Now, it depends on the potential of a certain borrower. So sometimes the potential could be 20 points and sometimes it could be 100 points, like I said. Basically, you pay for the service. You pay for each credit line, you pay about $45, and you pay the balances that your lender tells you to pay to the exact dollar that they tell you to pay. So it's just a couple tasks. Sometimes these tasks can include adding another credit line like we just discussed. Doing all these tasks to the T and then submitting them to your lender, you wait 3 to 7 business days and you get a brand new credit score. And that score can be drastically different, right? So that's all I have for the quickest tips on how to boost your credit score. Let me know if you have any questions. Again, you can contact me directly, whether it be through social media or through my email. I always read everything, so you send it to me, I'll read it at some point and I will answer that question, whether it be to you directly or whether it lead into a future podcast episode. Again, thank you guys for listening. Thank you guys for tuning in. Finance Basement out.